Welcome to the debate. Usually when we look at a satellite image of the Earth, the coastlines look perfectly smooth, right?
Right. Yeah.
The boundaries between the land and the ocean they look crisp, defined, and undeniably clear. I mean, from up there, it looks like a system perfectly in order.
From that altitude, yeah, it is clean. It's almost comforting, even. You certainly don't see the turbulence.
Exactly. But the moment you zoom in, right, and actually stand on that beach, the reality is, well, it's chaos. Jagged rocks, crashing waves, shifting sands.
Mm-hmm.
And frankly, that is exactly what multinational accounting looks like on the ground. It's a mess.
Oh, absolutely. Total mess.
So today, we are looking at a system that promises to basically take us back to orbit. The RTC Financial Reporting and Consolidation System, or FRC.
Right. FRC.
Yeah, and it's designed to manage period-end consolidations for these really complex group setups. But it begs a massive question for us today. Does a centralized, automated system of record like this actually strengthen data integrity?
Or does it just hide the jagged rocks?
Exactly. Does it create a false sense of security by, stripping away the localized context of those incredibly complex transactions? Because our source material today outlines the architecture and the reporting features of this FRC system, and it paints a very specific picture.
It really does. And I think, honestly, it highlights a fundamental philosophical divide in how we treat corporate data. Are we analyzing reality, or are we just, managing a narrative?
Well, I lean toward the former. My position today is that standardizing these totally diverse ERP inputs and automating the reconciliation process creates an undeniable, verifiable single system of record that finally eliminates dangerous human error.
And I will be arguing that forcing complex local realities into rigid, centralized hierarchies and relying so heavily on automated matching algorithms actually obscures the fundamental discrepancies that require deep human analytical scrutiny.
All right, well, let's jump straight into the architecture of this, because we all know the pain point.
We've all lived it.
Right. You've got subsidiaries running completely disparate ERPs, different local GA apps, wild currency fluctuations. I mean, the traditional mechanical effort of consolidating that at the end of the month is a nightmare.
It's an absolute nightmare, yeah.
So what FRC does is step in as the ultimate aggregator. It imports the granular transaction details. We're talking the general ledger, accounts payable, accounts receivable, from literally any underlying system. Cloud, on-premise, it doesn't matter.
Yeah, it absorbs it all.
Right. And then it normalizes that data. It takes every idiosyncratic, quirky local chart of accounts and it normalizes them into one unified structure.
And see, that word right there is the crux of my problem. Normalized. Or really, forces.
I'd call it translating, not forcing.
But, okay, normalization sounds so pristine, right? Almost clinical. We have to be honest about what normalization actually does to financial data at this kind of scale.
Which is what?
It fundamentally alters the original reality. When FRC systematically translates transactions into a required reporting currency, it is frequently doing so for subsidiary companies that do not actually operate in those currencies.
Well, sure, but
You are artificially converting a local reality to fit the global group's narrative.
artificially. I mean, I think that's a bit harsh. Look at the material. If you are a parent company, say the Chenille Group as they outlined, and you own Chenille Enterprises, which in turn owns a local entity like the Lishma, you have to have a common denominator.
I know you need a denominator, but
You can't consolidate a balance sheet in 7 different currencies. It's impossible.
true. That's true. But when you map highly complex, individually structured charts of accounts into a forced uniform template, you are flattening the topography of that business.
How so?
Because local subsidiaries structure their accounts in highly specific ways for actual operational reasons. Like, maybe they are tracking a very specific regional tax liability, right? Or they have a totally unique vendor expense profile.
Okay, yeah.
So when FRC absorbs that data and essentially buckets it into a generalized group operating expense to fit its rigid hierarchy, you lose the texture of the data. Vital context is just stripped away.
I see why you think that, but let me give you a different perspective.
Go ahead.
Think of FRC's normalization not as erasing the local language, but as providing a universal translator.
A universal translator.
Yes, the goal of financial consolidation at the head office isn't to pretend the local operational quirks don't exist. It's to make those realities comprehensible to the aggregate entity. You need to read the whole book, not just a bunch of disjointed chapters.
But a universal translator strips away cultural idioms. In finance, those quote-unquote idioms are the local tax loopholes, the regional operational constraints, the legacy vendor structures.
Right, but they aren't gone.
But they are obscured. When you strip those away to fit the group narrative, you lose the very triggers that would prompt a human analyst to ask, hey, wait, why is this anomalous?
Okay, if the system just locked you out after translating, I would absolutely agree with you.
Right.
But that's not how the mechanism works. Our source material explicitly highlights FRC's drill-down architecture.
Ah, the drill down.
Yes. When a normalized number is presented at the top level, let's say it's a consolidated revenue figure mapped from that local chart of accounts, that number isn't a dead end.
No, it's technically a hyperlink.
Exactly. If the context is ever questioned, a user doesn't just guess, they click. The system allows them to drill down through the normalization layers, essentially reversing the currency translation past the centralized mapping, right down to the individual line items.
Down to the journals.
Right down to the original journals or invoices. And it takes seconds. So the localized data is never lost. It's merely structured. The original AP and AR transactions are sitting right there beneath the surface.
Technically, yes. The architecture absolutely supports that drill-down capability. I am not disputing the software's engineering here.
Okay, so what are you disputing?
I am disputing human psychology.
Oh, go on.
Let's talk about how this tool is actually utilized in a high-pressure corporate environment. When a board member or even a senior controller is presented with a unified, perfectly clean, top-level report.
A green dashboard.
Right. Where every chart of accounts has been neatly mapped and every currency perfectly translated, how often are they actually going to utilize that drill-down feature?
If they spot an anomaly, they will. That's what it's for.
But the system is designed to smooth over the anomalies. FRC's marketing in the material even talks about providing peace of mind. But in modern finance, peace of mind is often just a corporate synonym for complacency.
I disagree with that.
If the top-level number looks structurally sound because the algorithm successfully mapped it to the right generalized bucket, the investigative instinct of the executive is immediately diminished. They just move on.
I think you have that entirely backward, honestly.
How so?
The smoothing over of the mundane mechanics is precisely what frees up the human analytical mind to focus on what actually matters.
Freeze them up?
Yes. Without aggressive standardization, highly trained financial analysts, people with master's degrees, spend 80% of their time just trying to match columns in Excel.
Well, that's the job sometimes.
But it shouldn't be. They spend hours figuring out which spot exchange rate was used on a Tuesday in March. It's a waste of their brain power.
Okay, so let's talk about that mechanism then. Let's talk about what happens when your universal translator hits a wall. Specifically, I want to look at intercompany reconciliations.
Oh, perfect.
Yeah, because the material leans on this heavily as a core feature.
It is easily FRC's strongest asset, hands down.
Let's explore that.
Because intercompany transactions are historically the most error-prone, frustrating parts of any period-end close.
Sure.
You know how it is. Subsidiary A posts a payable in one period, subsidiary B posts a receivable in the next period.
Or they use the wrong currency.
Exactly. Different currencies, or somebody typos the reference numbers. It's a mess. FRC steps in and automates this by establishing explicit structural relationships between those entities. It runs a fuzzy matching algorithm looking at the transaction date, the amount, the reference ID, all within a specific tolerance.
Right. It looks for matches.
And when it matches them, it doesn't just put a little check mark next to them. It automatically creates the elimination journals needed for consolidation.
Which is a huge time saver, technically.
It provides a complete, flawless audit trail of the elimination. That eliminates the mechanical friction so the human can do the actual thinking.
See, I'm sorry, but I just don't buy that. Let me tell you why.
Okay.
You're praising the algorithm for doing the easy work, while pretending it solves the core problem. Let's look directly at the mathematical example provided in the source material.
The Chanel example.
Right. The system looks at Company A and Company B. Company A posted £74,000 worth of intercompany transactions.
Yep.
But Company B only posted and matched £66,000.
Right.
That leaves an £8,400 structural discrepancy.
Exactly, and FRC instantly flags it. It doesn't hide it.
It flags it, yes. The material boasts that the algorithm will go out into the wider accounting system to try and find where that 8,400 was misposted. But what happens when it can't?
It alerts the user.
The material explicitly admits the system hits a wall. It merely flags the discrepancy so that, and I quote this directly from the source, corrective action can be taken by the accountants in Company B.
Right, which is exactly where human judgment should step in. The machine did its part.
But look at what you've done to the human accountant. You haven't solved the bottleneck, you've merely shifted it, and arguably you've made it way harder to untangle.
How on earth is it harder? The system just saved in the trouble of manually matching the 66,000 pounds.
Because you've destroyed their contextual thread.
I don't follow.
This is a phenomenon we see constantly in automation. When an accountant manually clears a 74,000-pound batch of transactions, they see the whole narrative.
They see a spreadsheet.
They see the flow of invoices. They notice that, oh, a specific vendor has been using an outdated reference code. Or they see exactly why the 8,400 was left behind. But if the machine clears the easy 66,000 completely invisibly in the background and then just spits out a glaring red 8,400-pound error on a dashboard, the accountant is coming in completely cold.
I think you're assuming this 66,000 provides necessary context when usually it's just noise. It's just routine invoices that matched perfectly.
Context is never noise in an audit. Automating the easy 90% degrades the human's ability to solve the remaining 10% because they lack the holistic view of the transaction block.
I just can't agree with that.
You're asking them to solve a puzzle where the algorithm has already hidden half the pieces.
But those pieces aren't hidden. Again, the drill-down mechanism is right there.
If they use it,
You are dismissing the massive value of solving that first 90% instantaneously. Before a system like FRC, that local accountant wouldn't just be looking for the 8,400 discrepancy.
no, they'd be checking the whole thing.
They would be manually checking the entire 74,000 line by excruciating line. By algorithmically matching the bulk of it based on date and reference, FRC instantly says here, look right here. This 8,400 is the precise point of failure.
Yes, it points.
It points a laser exactly where human judgment is required. It's not hiding the pieces, it's highlighting the one piece that doesn't fit.
Okay, but does the human judgment actually get exercised, or does the human just do whatever it takes to clear the error?
What do you mean by that? Clear the error is the goal.
I mean, we need to look at how this highly processed, algorithmic data is finally presented to the decision makers. The psychological momentum of this software is immense. Let's talk about the period-end dashboard in the Excel add-in.
Okay, the presentation layer.
Exactly. The dashboard itself treats the deeply analytical, interpretive act of closing the books like a simplistic factory assembly line.
It's just a workflow UI.
It's a grid of color-coded boxes. Green for complete, red for overdue. You have assignee initials and ticking clocks. The architecture of the system literally trains the organization to prioritize turning the boxes green.
Because they have deadlines.
But the overarching goal shifts from let's deeply understand our financial position to let's clear the red flags, run the intercompany match, and generate the reporting template. It gamifies the close in a dangerous way.
Efficiency is a prerequisite for analysis, though.
Is it?
Yes. If your team is buried in manual reconciliations, they're not doing deep analysis anyway. They're just surviving the close. They're working until midnight just to get the numbers out.
Surviving the close is one thing, but presenting a sanitized version of reality is another. And that brings me to the Excel add-in, which I find genuinely concerning.
The Excel add-in is brilliant.
The source material claims that because executives want, quote, beautiful, familiar presentations, FRC takes this massively manipulated, normalized data and pushes it directly into polished Excel templates.
Which they love.
The material uses a phrase that genuinely sent shivers down my spine. It says, FRC keeps the data right, while Excel makes it look right.
Why does that give you shivers? That's exactly what you want a presentation tool to do. Let the database be the database and let Excel be the pretty interface.
Because looking right is exactly what breeds executive blindness.
Oh, come on.
It does. You are taking data that has been stripped of its local idioms, mapped to an artificial hierarchy, algorithmically filtered for the easy matches,
All verifiable.
and then you are wrapping it in a beautiful, highly polished Excel bow. It gives the board of directors an absolute illusion of certainty.
An illusion.
Yes, when a spreadsheet looks that aesthetically perfect, people stop asking the hard questions about the messy realities we started this conversation with.
See, I actually agree that historically a perfect-looking spreadsheet is a massive red flag.
Right.
But you're discounting the actual mechanism of the FRC add-in. Think about it. Why are executives traditionally terrified of beautiful Excel sheets?
Because they're usually held together by duct tape and hard-coded numbers.
Exactly. Traditional Excel reporting is incredibly fragile. It's plagued by broken links. An executive looks at a cell and immediately wonders, did an intern accidentally delete a formula in row 42? Is this number hard-coded? Where did this even come from?
True, the origin is usually a mystery.
FRC's add-in fundamentally changes the mechanics of that interaction.
By just feeding it better data?
No, by embedding the core data integrity controls directly into the Excel interface. It is not just pushing static, dead numbers into a presentation grid, it's a live connection.
A live link to the database.
Right. If a board member looks at that beautiful presentation and feels skeptical, they don't have to call the accounting department, request a breakdown, and wait 3 days for an explanation.
They just click it.
They can highlight the balance right there in the Excel cell, select drill down, and immediately access the same transaction level detail that exists in the core FRC application. It bridges the gap between high-level presentation and verifiable granular data.
Assuming they know how to use it, and assuming they actually want to look that closely.
We have to assume some level of competence from our executives. The system provides literal, verifiable peace of mind. It's not an illusion of certainty, it's actual certainty, backed by a complete audit trail that stretches from the boardroom presentation all the way down to a vendor invoice in an on-prem ERP in a subsidiary halfway across the world.
I hear you. I really do. But the momentum of the system still pushes against that kind of inquiry. The system's own motto in the source material is literally designed for clearance.
Which is what a consolidation tool should do. It clears the data for reporting.
Right, but when your overarching operational goal is clearance, when you group subsidiaries by regional location or tax purposes purely to roll them up faster, the deep, scrutinizing human analysis naturally gets deprioritized.
I don't think it gets deprioritized.
Yes, the data integrity controls are technically present in the Excel add-in, but structurally, the entire environment is screaming at the user, the algorithm has handled it. Turn the box screen. Approve the sheet.
You're acting like the workflow is the enemy.
I'm saying we are prioritizing a smooth workflow over a deep understanding of local financial anomalies.
I just don't believe you have to choose between a smooth workflow and deep understanding.
You usually do in practice.
Not with tools like this. If you look at the sheer breadth of what FRC is handling, multi-company consolidations, posting final accounting adjustments, managing complex currency revaluations, handling statutory reporting adjustments. Doing all of that manually across disparate systems leaves zero time for the analysis you are so fiercely advocating for.
It takes time, yes.
It takes all their time. By mapping data to a central chart of accounts and translating it into required currencies automatically, the system saves thousands of human hours. Those are the hours that can now be spent investigating why that 8,400-pound mismatch happened in the first place.
Well, I will concede that the mechanical efficiency is a necessary evolution. I really will. FRC undeniably organizes the period-end close with a rigor that is incredibly impressive.
It's robust.
Very. The logic behind its intercompany matching and elimination journals is technically sound. But we must remain vigilant about what we lose when we let software act as the ultimate arbiter of financial reality.
Fair point.
Centralized charts of accounts, algorithmic matching, and color-coded executive dashboards, they all risk sanitizing the messy, localized realities of global finance. When we prioritize clearance, we risk losing the narrative of the business itself.
It is a fascinating tension, the balancing act between achieving group-level uniformity so the business can actually function, and maintaining local-level accuracy so we don't lose the plot.
Yeah.
It is arguably the defining challenge of modern financial architecture.
Absolutely. The intersection of automated financial software and human analytical judgment is it's a really complex frontier. We are trusting algorithms to map our reality, to translate our idioms, but it is ultimately the human who must interpret whether that translation holds any actual truth.
Which brings us perfectly back to where we started today. When you look at the Earth from space, the borders are perfectly clean. It's a beautifully consolidated dashboard.
Just don't look too close.
Right, because the closer you get to the ground, the more jagged and complex the terrain becomes. The central question really remains, are systems like FRC helping us navigate that jagged terrain more safely, or are they just convincing us that the rocks aren't really there?
That is a question every executive should be asking themselves the next time they sign off on a perfectly green dashboard.
Indeed. Thank you for joining us on this deep dive into multinational consolidations. We leave it to you, the listener, to consider the map, the territory, and the tools we use to bridge the gap between them.